The Dow and S&P 500 closing at new all-time highs, but one stock not participating in today's rally. That would be NVIDIA. Shares of the chip giant edging lower. And this is an example of what our next guest says about this bull market, that it is indeed an everything market. And joining us now is veteran strategist and author of the Paulsen Perspective Substack, Jim Paulsen. Jim, it is great to have you on the show. Let's just start right there, Jim. You say the stock market here has finally taken on the character of a new bull. It has become, you say, an everything market. What do you mean by that, Jim? Walk us through it.
Well, I think normally when a bull begins, it gets full support from the policy officials, Josh. Usually we're heading into a recession and the Fed starts easing even before a bull starts. They're concerned, and so they ease, and then bond yields go down, the money supply is going up, fiscal stimulus is advancing, the dollar weakens as interest rates come down. In other words, we're giving it the full boat of stimulus, and that's why the beginning of a bull is so fantastic, not only in terms of how much the market rises, but how much its broad participation across a variety of names, everything from defensive stocks to tech stocks to cyclicals, everything goes up at the start. We didn't get that in this bull because the Fed has remained tight in this bull market until about 2 weeks ago. It's the only bull market in post-war history where its entire existence was under a tightening Fed. But now what we have is, like the start of a bull, the Fed's dropped funds rates, bond yields have come down. They've done that. Money supply is accelerating, fiscal juice is expanding, the dollar's coming off a little bit. We're getting a full boat of support, and you're seeing for the first time a broad participatory marketplace where tech is still hanging in there and the old leadership, but you're getting brand new leadership across all sectors, small and large cap, equal weighted than not, cyclicals and smalls, even international stocks starting to partake in this. And I don't know how long that'll last because this is a 2-year-old bull, but I call it younger because the Fed is just now starting to ease.
So how much runway do we have in this bull market?
Well, I think that's a great question, Madison. I think we still have some fair amount yet. It is 2 years old. I think the average bull's closer to 4 or 5 years. Also, I think that there's the main thing I look at is the slack in the labor market, and the unemployment rate just went up about 8, 9, 10 of 1%. There's another 1% slack we could employ again, allow us to grow for a while. But in addition to that, I think the labor force usually rises 5% or more above its previous recovery cycle peak, and we're still only 3% above the previous peak. It'd be one of the lowest recovery endings we've ever had if that happens. But if you put on another 2 percentage points of labor force, 1% lower the unemployment rate, that gives us 3% more in the jobs market. So I think there is quite a bit more room. In addition to that, I just don't see many vulnerabilities. The household and business sector have very clean balance sheets. They haven't overborrowed. They're highly liquid. Money market funds to disposable personal income is close to the only time it's been higher was at the worst of the great financial crisis. And I think that confidence among consumers and businesses are still pretty low, still pessimistic. We generally don't end a bull until there's greater optimism that's obvious in the economy and on Wall Street. We haven't seen that yet. So I don't know if I give you an exact number, Madison, but I think we've